Today with the Futures Now newsletter. You'll get the latest news, real-time trade updates, and a sneak peek at our biggest interviews. Stay ahead of the headlines and make today's events tomorrow's profits. Sign up now at cnbc.com/futuresnow email.
Welcome to Futures Now. I'm Jackie DeAngelis coming to you live from the commodity desk at CNBC Global Headquarters. I was on assignment earlier this week and I heard there was a little bit of an uproar with Mr. Chu filling in for me. But today we have Scott Nations and Anthony Grazanti here. They are my wingmen, and we're going to break down another busy day in the markets. Here's what's coming up on the show. Gold up more than 8% year to date, and one top analyst says that the yellow metal is headed for another leg up. We're going to have Todd Colvin of Ambrosino Brothers here to tell us why gold's run could be far from done. Plus, take a look at crude oil hitting a 3-week high today, topping $50. This has one of our traders buying oil, even at these levels. He's going to tell us the trade later in the show. First, though, markets rallying today with the S&P erasing its losses for the month and the Dow and the Nasdaq also climbing higher. Our first guest sees another good year in the cards for stocks, and he's here to tell us what's going to drive the market higher. Stephen Parker is the head of Thematic Equity Solutions at JP Morgan. He joins us now. Stephen, give me the bull case for stocks, because it's hard at these levels to buy in.
Thanks, Jackie. Good to be back. Look, I think the bull case for stocks is really about an improving global growth outlook, and that's going to translate into better earnings. That's been the thing that's really been missing over the last couple of years. We've seen stocks move higher. We haven't necessarily seen the earnings case come through. And I think when you look right now, when you look not just in the U.S., but really around the world, growth is getting better. You're starting to see that translate into a positive momentum on the earnings front, and not just from some of the more secular growth parts of the market like technology and healthcare, which have led over recent years, but really the more cyclical parts of the market, things like banks and energy, which are really leveraged to an improving U.S. and global growth story, and that's where I think you're going to see tailwinds for markets. Any
examples you can give me as evidence of the alleged growth you're talking about? Sometimes we've spoken about this global growth in the past, and it doesn't necessarily pan out.
Well, I think you're seeing it. One of the things that we watch closely is earnings revision. So what are analysts seeing for individual companies? And historically, you see analysts come in with a really positive outlook, double-digit sorts of growth for the market, and then that starts to get revised down throughout the year. We're not seeing that this year. We're actually seeing revisions hanging in there, again, both U.S. and globally. And I think a lot of that has to do with the better consumer sentiment, the better business sentiment, and I think you're going to see that. We saw it in Q4 earnings, and I think that's going to continue in through the first half of this year.
All right, can we talk politics for a second? Because the market took a little bit of a breather when healthcare reform didn't pass through. Do you think the confidence is starting to waver in terms of what Washington is doing right now?
Well, I think we know that policy never proceeds in a straight line. There's going to be fits and starts. And clearly, in recent months, there's been a lot of enthusiasm around a lot of the pro-business policy. I think now markets may be in for a bit of a pause as we see whether or not that can translate into actual policy action. But I think that while that is potentially an upside driver for markets, you do have that basic fundamental tailwind around global growth that should be supportive, even if we don't see policy come through necessarily the way that markets are expecting.
How does the trend line higher, Stephen, look? Is it a slow grind higher? Is there a certain part of the year that you think will be the time that we see the biggest kind of move? Hard to predict, but what do you think?
Yeah, I do think it's going to be more of a slow grind higher, and we're probably going to see some ups and downs and some volatility in markets. Right now, I do think people are going to be focused on the policy front, and we're still going to need to wait a little while till we get into earnings season to really see if we're seeing that come through. But I think what we're telling clients is be patient right now. We may see some volatility, but if you do see a pullback in markets, that's more of an opportunity to buy than a reason to think that this rally is over.
Scott Nations, jump in here.
Yeah, Stephen, Scott in Chicago, and I have a question because you're talking about the global economy, and it certainly seems like Europe has finally turned the corner, at least if you look at the interest rate picture, that seems to be the case. But now they're starting the gritty work of Brexit, finally. And then if you look at China, well, that continues to be simply a big question mark. So which of those or another region is really going to do the heavy lifting when it comes to the global growth that you're talking about?
Well, this is what I think is so unique about where we are in the market cycle right now, because for much of the last couple of years, you've had the U.S. economy leading, and you've had different global markets jumping in here and there. Today, for the first time in a long time, we're actually seeing coordinated growth across the U.S., across China, across Europe, across Japan. we're seeing it from everywhere. And in a lot of ways, having that more coordinated global growth story is a lot more important than having one or two markets that are driving it. And you talked about Brexit, you talked about China. Those uncertainties are always going to be out there, but what we're seeing around the world is confidence both from the consumer and from the business sector, which I think is a good leading indicator of growth and spending ahead.
Grizz is going to jump in with a question.
Yeah, Stephen, back to policy initiative. What do you think is the biggest one that's going to either make or break this market? Healthcare didn't seem to do it when it failed. Is it the tax cut?
I think that's where people are certainly going to be focused. And I'm not a policy expert. It's really hard to predict how these things are going to play out. But when you look at what could give that boost to confidence, could give that boost to earnings, clearly tax reform, a tax cut, seeing something happen sooner rather than later is probably going to be the policy catalyst that people will be watching most closely as it relates to markets.
Stephen, don't want to put you on the spot for the last question, but what's your price target on the S&P for the end of the year?
Our target for the end of the year is actually only modestly higher than where we are today, so probably another 2 or 3% higher. But I think what's important to understand, that's the base case. There's a lot of things, whether it's from a policy perspective or from a global growth perspective, which may end up surprising to the upside, which would get us closer to a high single, low double-digit type of year for stocks.
All right, Stephen, great to see you. Thanks so much.
Good to see you. Thanks.
Grizz, you heard the man. You're trading the S&P. He also said it doesn't always go up in a straight line. So what's the futures now play here?
No, it doesn't, Jackie. And I think the market's going to take a breather now. I'm a seller of the June E-mini. I'm selling it at 23.65 or 23.63. I put in my stop at 23.75, and I'm looking for a move back down to 23.40. I think the market needs more than just policy talk. They need real action. We saw what happened when healthcare failed. Yeah. Another thing that I've been looking at, and Warren Buffett calls it his best indicator ever. If you look at the total capitalization of the market versus GNP, we're at 130% right now. That's way higher than the normal average of 80%. So the market seems to be a little bit overvalued right now. I'd like to see a little bit more substantial come out of policy before I buy into this.
Okay, Scott, your thoughts on that trade?
I generally like to trade. The only problem I have is, and Grizz knows this is futures now, and we're talking about some things that are much longer term. And I think that the momentum, the short-term momentum, is a little bit higher. So I don't hate the trade. I'm not certain I would rush to get into it. I might look for a little confirmation before I got short here.
All right, let's get the risk
Scott,
reward.
Okay,
go, Grizz.
Got it.
No, go.
I was just going to say it real quick. Today was a perfect example, Jackie. We were talking about the tax reform. The market was up 90 points, and then there was a comment that it might be delayed a little bit. All of a sudden, the Dow lost 50 points on that alone. So
yeah,
I think that the market's a little skittish right now.
This market is certainly counting on tax reform, even more so probably than it was on healthcare. So we'll be watching closely. But guys, let's get the risk reward here before we move on. Grizz is selling the S&P. He thinks it's going to take a breather, targeting a move to 23.40. Each point in this trade worth $50. So he's risking $600 to make $1,100. Okay, moving forward, let's talk about gold falling for a third straight day. But our next guest says that the yellow metal is poised for another leg up. Todd Colvin is the Senior Vice President of Global Institutional Sales for Ambrosino Brothers. He joins me now. Todd, why is gold headed higher from here? This has been a troubling trade.
Well, Jackie, I think there's a lot of reasons why gold does what it does. It's very reactionary, and it has been here since, I guess, going back to the end of the year. We've seen, beginning of 2017, we've seen gold pretty much rally. It's had a few hiccups, but ultimately right now it's the uncertainty, not so much about U.S. growth. We saw today in the revisions that we've got some growth, and we'll find out in about a month whether we have real growth in first quarter. But ultimately, I think right now gold is looking at the macro picture. It's not just U.S. growth, it's Fed policy, it's U.S. fiscal policy, it's European elections. And I think there's a lot of things out there that are going to keep gold bid until we get confirmation. And confirmation, it could be off to the second half of 2017 before we get it. So I'm pretty much a gold buyer and holder here until then.
Well, part of it certainly is global risk, as you mentioned, but part of the gold trade also has been the Fed, correct?
Well, it's always been about the Fed, because when you talk about currency risk and you talk about Fed risk, they always end up in the gold bucket somehow. And when we see moves like we saw overnight, we saw the dollar bid overnight, and lo and behold, gold is lower today. But it certainly hasn't seen the big moves that we historically would see on a big move in the dollar or vice versa. So I think right now it's about Fed expectations, and we heard this week from Vice Chair Fisher saying the possibility of 2 to 3 rate hikes more in 2017. Echoing his comments from January of 2016 of 4 rate hikes in that year, and we didn't get it. And I think the Fed right now is still seeing the economy and policy as glass half full without any real evidence. And they need to get those first quarter hard data numbers in. They need to get through some of these cloudy events coming up, like the French elections and more FOMC meetings, in order to see where policy is really going to go. Because right now, gold is a safe place to go. And with equities still on all-time highs, I know we're not trading, to the dime on them, but if they're still on all-time highs, there's a big downside risk there that gold provides insurance against.
All right, but you're bringing me to my next point, which is this. When I think of gold, I think risk off. When I think of equities, I think risk on. My previous guest said that he thinks the market is slowly going to grind higher from here. Can these two move together, even though fundamentally they shouldn't?
Absolutely, they can. And it's when you look at what's happened in equities, equities continue to go higher, whether we talk about growth or whether we talk about rate hikes or whether we talk about risks in Europe or fiscal policy in the U.S., because look around. There really isn't another place to go if you're a long-term investor. And long-term now has gone from 10 to 15 years to maybe 2 to 3 years. And there just isn't anywhere else to go to get the yield. So you're going into equities and you're taking a bit of a risk to make a little bit more that you can't make in the riskless assets that you used to be able to capture. So gold, yes, absolutely. The more equities go up, the more gold can go up lock and step, because they're acting as sort of a hedge to each other.
Okay.
And I think that's going to be one of the big reasons why gold continues higher.
Grizz, jump in here on the gold trade.
What's your downside for gold? What if tax reform passes? What if Brexit goes smoothly? What if the European market starts performing a lot better? Then what do you see gold doing then?
Well, I think that gold right now, we talk about tax reform, that's already priced into the equity market, not so much in gold. So yes, there is some downside to gold. But if you go back 12 months, we were trading around 1250, and if you look at the boards today, we're trading around 1250. So I think gold, the home for gold right now is going to be between 1200 and 1300. The big oops, moment in gold is if you get down below 1175, but I don't see that happening, certainly not until the Fed gets its legs back under it, and that could be a year or two.
All right, Todd, great to see you. Thank you.
Thank you very much.
Talk to you soon. Let's get straight to it. Scott, you're not usually a gold bull. He is a gold bull. What are you doing with this trade?
Well, I've been surprised. I think I've surprisingly been a gold bull over the last couple of months, but not now. I mean, we saw it get into this 1250, 1260 range, which is important. I'm a seller. I want to sell the June gold contract at 1252. My target to the downs, and that's about where it was when I put this trade together. We may not get this trade on, but I'd sell it at 1252. My target to the downside, 1240. My stop to the upside, 1258, because if we get above 1260, I will admit I do not want to be short. I think it's run out of juice technically. I don't see any looming fundamental reason that it will get above that 1260 level. The things that Todd mentions are quite a ways out on the calendar. Earlier today, the relative strength index was 61, not quite overbought, but a little stronger than we'd want it to be if we were going to be a buyer. I do have, again, a very tight stop. I don't want to be in this trade if it gets above 1260.
Grizz?
You know, it's funny, Jackie, when I looked at Scott's trade this morning, I thought, is he peeking over my shoulder and watching what I'm doing here? Because I had the exact number, that 1260 number, and I thought I do not want to be short if we trade above that. Pardon?
Do you think he was cheating off of your test?
I think he was. He could have been cheating off my test. Maybe got a camera in my booth or something. But, Jackie, I looked at the same thing. I said 1260. I don't want to be short above that. And, Scott makes a great point here. Our guess is he's counting on a lot of things here to kind of go wrong a little bit for gold to be a bit higher. I'm looking at things that's slowly grinding right, and then gold's lower. Look at the dollar. The dollar seems to have found a bottom around 97 and a half, 98 in the dollar index, and we've getting above that. It's weighing on gold a little bit. So I think for now it's kind of run its course. If the tax reform fails, then yeah, gold's going to trade $1,300. But It doesn't look like that. And as Scott said, it's down the road.
All right, Scott, final word to you, then I got to go.
I think actually the price action we've seen since I put this together, where it's just come off slowly during the course of the morning, it speaks volumes to my thesis.
Okay, risk reward on the gold trade. Scott's selling gold, targeting a move down to 1240. Each point in this trade worth $100, so he's risking 600 to make 12. Okay, let's move on and end with crude oil hitting a 3-week high today, seeing its third straight day of gains. Over $50, Grizz. It's tough to want to get in here after the move we've seen over the last couple of days, but you think that there's strength?
Yeah, I do. I think there's solid footing. I'm a buyer right now, Jackie, of the May contract. 49.60 is where I'm buying it. That's right above, actually, the 21-day moving average. And that goes back to what Scott was saying about the technical levels. I put my stop in at 48.40. That's actually below the 200-day moving average. So we'll definitely find support there. And I'm looking for a move out to 52.50. So not a real crazy, let's say $60.
Right.
Although I still think we can hit there by the 4th of July. But I just want to see a little bit of strength right now. I want to see the market kind of hold it. We talked about on the halftime report what OPEC was doing, how U.S. production is down. Now we need demand to start picking up.
Yeah, it's funny because when you and I were speaking the other day, you mentioned that if you were a trader and you missed that move below 50, it was really difficult to start trading crude in this tight range. Now I feel like this is the reverse. You got to get on this move up over 50 because it could get stuck again.
That's actually right, Jackie. We mentioned how, between 47 and 49, it seemed to be stuck. Now we're above that. It looks like it's breaking out again to the upside.
Okay, Scott, I want your reaction to the crude oil trade. Are you on board here?
I think he's got the direction absolutely right. I also like the way that he's willing to wait a little bit to get long. It's easy to buy markets at the top. It's easy to get excited and just buy them at the market. I think this makes a tremendous amount of sense. You know, if he doesn't get filled, if he doesn't get to buy the contract and it continues to go higher, then c'est la vie. That's the way trading works. He tried to put on a good trade, an intelligent trade, and in doing so, he didn't get filled, and he missed out on a profit he would have made if he just bought at the market. But you know what? Trades like this will make you wealthy, and you don't have to worry about sleeping at night.
All right, Chris, final
it's like
word
a bad
to you.
date,
That was
Jackie.
a stellar endorsement there.
It's like a bad date,
partner.
Jackie. You move up. Yep, when it comes out bad, you move on to the next one, like a bad date.
Yes. Okay. Let's get the risk reward on this trade. Grizz is buying oil with a target up to $52.50. Each dollar in the crude oil trade is worth $1,000. He's risking $1,200 to make $2,900 on that trade. Okay. That's going to do it for Futures Now. I'm Jackie DeAngelis. Remember, if you missed any portion of the show, head back to the website, futuresnow.cnbc.com. Everything is there for you. And for the latest headlines and sneak peek of what's coming up on the next show, be sure to sign up for our brand new newsletter, launching next Tuesday at cnbc.com/futuresnow email. You can find the link to that and real-time trade updates on our Twitter account at CNBC Futures Now. Meantime, we'll see you for our next live broadcast. That'll be next Tuesday, 1 p.m. Eastern. See you then.